Good afternoon, ladies and gentlemen. Welcome to today's weather forecast report on the Asian monsoon, one of the most powerful and influential weather systems in the world. This annual phenomenon not only shapes the climate of Asia, but also has far-reaching consequences on agriculture, economies, and ecosystems across the continent and all around the world. As a meteorologist, I will walk you through the science beyond the monsoon, its stages, and its effects on various regions. Welcome to Economica, my friends, and glad to be back with you today. And I will explain a detailed time series analysis of the main Asian market index, including the Nikkei 225, the Hang Seng, the FTSE China 50, and the Nifty 50, and the Nasdaq Global Index. And we will try to see if there are some volatility patterns emerging. And as you can see from this picture, a rainy and a storm and a monsoon coming on Asian markets. And why we should be bothered, if you can be bothered, finding out if some more volatility will come from Asia to flood the markets with more selling pressure and a downpour of stock prices, and so that we will see a broadening of the stock market correction. So let's start with the economic indicators. Why Asia seems a very far away spot in the world, but how Asian economies are positioned in the global economy. And we know very famously that, for example, the Japanese economy has an astonishing debt-to-GDP ratio, which is 255%, as you can see now, and the government deficit is always very large. So they run a budget deficit of 5.5% or 5.8% or so forth and so on, or a surplus. I think this must be a deficit as usual, but the most crucial data is that as many other economies, the deficit, when it grows more than the GDP growth, then at the end of the day, at the end of the year, then the aggregate of debt to GDP ratio grows, and so you end up with more debt, more public debt than the growth of the economy. Yeah, we have a budget deficit that never ends. So the Japanese economy, they are 255% debt to GDP. India, what about India? India is a country that is growing, but the government debt to GDP is 81.5%, and they still do a lot of public spending with the 5-6% that fiscal deficit. It doesn't matter. I don't give a damn. Monsoon, rain or shine. They're printing Indian rupees. There was no rain coming, and the Chinese government also, the Chinese economy also has been performing more or less on a steady growth pace, but they also need a very large deficit to finance the economy growing, and so we see that the debt to GDP ratio has gone from 20% to 83.4%. So the debt to GDP ratio has grown a lot. And so the marvelous, the wunderbar China economic growth has not come without any bill to pay, but it's the debt to GDP ratio has steadily increased, because the Chinese economy works a lot with public spending, and a lot of investment in the economy, they are made through public spending or government commitment to building infrastructure and all what is required to make the economy grow and create jobs and so forth and so on. And then another thing that I noticed, now I'm picking all the wrong stuff, but for example, we have an overview of the Hong Kong economy. So the Hong Kong economy is a very small island, very peaceful, no problems, and they have 9% debt to GDP ratio, nothing to worry about. But the Asian economy, like Asian countries like Japan, for example, or Singapore, they are also famous for very high real estate prices. And I have just picked here on the Hong Kong residential property prices, and we can see that property prices in the tiny, itchy, mitchy, small island of Hong Kong, which are two islands, not one island, they are two islands, they've been on a quarter-on-quarter decline since the start of 2022. So there have been 2 years, now 3 years now, of double-digit declines in residential property prices. And we know that Hong Kong, it's a prime spot for the global real estate market. And when we have this consistent decline quarter on quarter of double-digit declines in residential property prices, this also is a sign that liquidity and appetite for the real estate market has been steadily decreasing, and then that property prices and the real estate market on a wider perspective have been forced to reduce prices, so that there is no bidding for very high expensive properties in a hotspot as in a prime location as Hong Kong, prime real estate market, also because there is no space where to live in Hong Kong, so that's why house prices, they are so over the moon. And this is another small tiny data that tells us that property prices in Asia, they are not growing but they are decreasing, and this has happened also in China, a deleveraging of the housing market. And we know that real estate developers like I don't remember, but they in Chinese market they defaulted on their debt obligation, and so there is this dynamic going on. And if we move to Australia, Australia is a wonderful country. They don't have any sort of high debt to GDP ratio. Government budget is in a surplus, which is wunderbar, which is wonderful. And they have a tiny bitchy problem with inflation rates, with prices. Prices are very, very high for ordinary consumers, but the idiosyncratic problem of Australia is this one, that the private debt to GDP ratio is 180%, more or less. Maybe 2024 200% is very, very high. So the private sector, the median household or the business or the corporates in Australia, they are pretty much leveraged a lot. And there is a component in Australia also of the real estate market. So also in Australia we have there has been for ages and ages and years and years and years a thriving real estate market. See that the Australia mean, so the average oh come on, no, what's going on? Oh, I'm not logged in, but anyway, the average price of the median house it has grown to almost $1 million Australian dollars. So there has been a sort of, there is a bubble also in the real estate market of Australia. Let's see, residential property prices. Oh, there has been a bit of decline here. Oh, it does allow me to expand. Yeah, I mean, it seems that they've been growing on steadily year on year with some ups and downs. Now I don't have a very detailed data of this. I'm just picking the charts, but we can see that, for example, after in 2021 we had a growth of 23-24% in house prices, but the average house price in Australia it was in the third quarter of 2024 of 985,000 Australian dollars. So we are talking about over $1 million Aussie dollars, which is not small change. And so there are all these dynamics that Asian economies, they are maturing, and they are not so developed country, but they are well established advanced economies with functioning financial markets. And so we see that debt to GDP ratio, they are approaching the 100% mark. We have high real estate prices. Some countries like Australia, we have high inflation. Also India, which is a fast-growing country, it has a fast developing middle class. This doesn't come with without public spending, and we see that there are accruing deficits year on year, quarter on quarter, and the debt to GDP ratio tends to grow. So at some point this could generate some volatility in also in financial market, in financial assets, especially if and when liquidity starts to be scarce. There is too much leverage in the economy, and there is a stock market that is too high in its valuation. So at some point something basically has to give to bring public sector and private sector in balance, and also the how asset prices have inflated, real estate asset prices have inflated, and then this become unaffordable, as we can see in the Hong Kong market, for example. There has been a decline of double-digit decline on real estate, residential property prices, and the median house price in Australia is almost $1 million Australian dollar. So there are some factors which tells us that the wider economy is out of balance, and so eventually financial assets will have to reprice. And so if we, for example, we go and see the charts of the main Asian indices, here we open up the Nikkei 225, the Japanese Nikkei 225, and we see here that we peaked with a historical all-time high after these long decades of this long curve, and that's peaked more or less at 42,300, 400 points. I can't, whatever. We see here that we basically the market has turned around. The market is turning around. What goes around comes around here, and so we have this market activity. We picked here. We have a very volatile month in I think this was July 2024, and so this is on a 3-month. It's on a monthly perspective. Yeah. So this one was July, and then August was very volatile. September was very volatile. So we have this topping formation here of the market. We topped out here, and it seems that the market it's not consolidating, but it's going sideways. We have a top, it goes sideways, and then it starts to pull back down. Okay, and it's basically it's visible from the charts in the from the charts in the from the candles, sorry, in the chart. Sorry, I was distracted by the Fibonacci that went away. It's visible from the candles. This is the 3-month candle, so 3 months period. Every candle is 3 months, and we see that the candle is red. So the market has been selling off. It went down from 42,000 and something to now we are at 37,000. So this is a move of how much has been the Japanese market has moved. That's why this stuff is going. It's a 12.5% repricing from a historical all-time high. So higher than this, it's never been in 30 years, something like that, 33 years. And so the market is repricing, and I think for those who are in Europe or in other parts of the geodesic planet Earth, then we don't pay too much attention. Because Asia for European time frame it's overnight, so we don't have the energy to be awake at night and check Asian markets. But anyway, we see that the market is repricing, and this is a 12%. Technically, this would be a double top for those who love technical charting, and this seems to me a double top. And so we have here the index is pinching the all-time high, it repriced down, lots of volatility, and then we have a confirmation here, and basically the equities in the Nikkei 225 are repricing down. We have moved 12% down, and Fibonacci retracement that I drawn up. It's here it's 33,585. So we can see here that yeah, first fib lab it's 20%, and then this one it's a very nice 37% more or less, yeah, 37%, and we will chop and change around 26,700, and we can easily make the parallel charts. Just bear with me 1 second. Yeah, maybe we can simulate bar pattern. Okay, if we flip around this thing, flippity flip, yeah, we see what could be the parallel, the similar move of the market in that respect, repricing the market at 20% or 37%. This would be a big move, but nevertheless, we from a technical standpoint, this is the Nikkei 225. The RSI, as all you can see, this line is the moving average of the RSI. So this RSI is very wide. It's 80-20. Okay, so we are overbought here. Here we have an head and shoulder already in the RSI, and here the line, the RSI indicator is crossed to the yellow line. So it's like confirmation, signal confirmation that the market is moving down. So this it's very likely to continue down at some point. So it goes here, the RSI here, it's here. So I think it's, I suppose it's reasonable to expect that the market can reprice at least to 33,500, which from the top, yeah, we said it's 20.5%, somewhere in that range. Let's see the monthly chart, doing this very nice technical analysis of zip, nothing at all. And yeah, 20% is here, and if we basically reprices down to this level of 26,700, it's 37% down. But basically what happens is that I think the bars pattern is very similar. Okay, if we flip around, flippity flip around this stuff, you see that we have a very similar pattern, yeah. And let's say it ends up here in this green shaded area, which is the Senkou AB span. So if we see how the Ichimoku trends work, the indicator, I mean, most of the people, I hope they have a rough idea. We see that here, so the price goes here into this shaded area, and then it bounces back up. So the market can go down, test this level, and then it can go back up again. If it breaks here, then it's the shaded area from green, it turns to red, because here you see breaks here, and then you have a flipping around of the Senkou span, and it tells you that it's a bear trend, a downtrend, which lasts for months. Okay, so what I'm trying to convey is that the market can go down 20, 30, 40%, the Japanese market, but still it will preserve a buying opportunity for an uptrend. So it will be a crisis, but not a crisis, because the market can bounce back up, even if it goes down to 20 or 30%. The market can go up, of course, or it can continue to go down. So I'm making a mess of all these things. Let me clear up a little bit. So okay, but nevertheless, we see that the RSI is breached through the average. So now it's reading 55. When it goes below 50, it's the relative strength is relative weakness. So the market is weak, and then more selling piles up. And Nifty 50, okay, the Indian market also is peaked. The Nifty 50, one of the most representative stock market index for India. We see here we have very overbought, was 83.5, super overbought, and so the RSI is turned down. We are at 53, so very close to crossing the 50 parameter for relative strength or weakness in the market, and we see that we can see it's 1, 2, 3, 4. It's about 5 months of straight selling, which is so markets are correlated, especially equities, stocks, and what goes around comes around, and now we are down 15% in India, 12% in Japan, and it can go down another 22% or 37% more or less, 37, 38% from the peak. And I will not I can't exclude a similar scenario of a broader repricing of stock markets, especially if then what is this activity in Asian markets if basically picks up also in Europe and in the United States, and then money starts to come out also from US stocks and from European stocks, then we will be totally in another ball game. Only the Hang Seng has been in a bear market. The Hang Seng has basically started its repricing in February 2018 and February 2021. So it started its repricing with the leverage, with basically with the falling prices in the real estate market. So there has been already a bear market in the Hang Seng, and the bear market was, let's say, from here to here, it's 53% from this peak, 56%. It's a big bear market, and here we have a double bottom, but we are in this shaded area, and we will have to see if the market, basically traders in Hong Kong, they want to price high and break through. If they break through, then you have an uptrend because you go through this red shaded area, but on the same time the market can turn down. So if we have, for example, a global sell-off, then also the Hong Kong market, it won't be very easy to go up. But if we take our beloved DAX, so the DAX, it's incredible. Okay, so German economy has been in recession Q3, Q4, Q1, Q2, Q3, Q4. It's been in recession for the past 6 quarters, and instead the market has gone gangbusters. It has gone from 12,000 to 23,000. This is totally bonkers. And the RSI is very overbought, 79, 80, so it's hugely overbought. And these are the volume profile. I mean, the volume profile doesn't tell there is any volume here. We are really in a tiny air bubble pocket here, from the 18,000 going up to 22, 23,000. We are really in an air pocket bubble. There is no volume support like any significant market volume that backs up this huge speculation, and so it's very, very possible, and it's a necessary outcome for the market to turn around, flip around, and discount the price of German equities according to how the economy is performing, and what are the perspective economic the economic potential of the German economy, because it's in the doldrums. We don't know if the automakers will basically manage to turn around their production model. So there are so many unknowns in the German economy, and so I think that the correction is very much overdue. It's totally the DAX valuation is totally unjustifiable unless it's a speculative bubble as much as the Nasdaq or the dumb Wall Street speculators. So we can go through the charts and we can see that the Nikkei 225, the Japanese market, has turned around, and this tells me also that we will have probably a strengthening of the Japanese yen, money coming out of equities and going into the Japanese yen, flight to quality or to safety. So I would be short any cross pair, which is Aussie dollar, Japanese yen, Canadian dollar, Japanese yen, Swiss franc, Japanese yen, pound yen, euro yen, dollar yen. I would be short all the time, more or less, whenever the Japanese market sells off. And so, also the Indian market, we see that it has been on a 5-month correction, both the Nikkei, the Japanese market and Indian market, they are both down by 12 and 15%. And this will it's coming, the Asian storm, it's coming to Europe, and it's coming to the United States, and I think there will be more stock market correction to come and to have. So let's try to go and see, dear friends, what are our volatility measures. And we take our favorite color, which is red passion. And okay, so we can see, I'll try to go fast, because I know I can understand that most of you don't find boring to go through the volatility data, but these are necessary. Anyway, if you can just write down a comment, leave me a like, any suggestion that you have, you are very welcome. If you're watching the video, thanks a lot for taking the time to watch my video, my content. I think it's very interesting. So here I can show you what is the annualized standard deviation for every and each index that I put in this basket, which is the DAX 40, the Indian and Nifty 50, Nikkei 225. This is the Jakarta Stock Exchange. This is the Taiwan 50 daily return, Taiwan weighted, KOSPI 20, the Nasdaq, the NQ Global, the FTSE China, the Hang Seng, and this is the let's see if I it's an ETF, which is, yeah, the Chinese market's been sideways for most of the time. This is the MSCI, yeah, that's what it is, the iShare Core MSCI World ETF. So it's an ETF that basically tracks the daily return of all the world economy, or the world indices. And yeah, so we see that the annualized standard deviation of daily returns, the DAX, it's a 19%, almost 20%, but we are in a range between 16 to 26% for more or less volatile stock markets. We have the the annualized standard deviation and the historical standard deviation for daily return. So we see that this data, it's it's a daily return, but it's not annualized, and we see that on average, historically on average, the volatility in DAX index, it's 1.25% for the DAX, or it's 1.66% for the FTSE 50 China. And so these parameters will tell you what is the annual volatility, the daily volatility that you can expect. And yeah, here we have the charts, the first charts that the machine gives out, which are the 7 days and 21 days rolling standard deviation. And we see that some lines there just on the upside, so they are pointing to higher volatility. So the Nifty 50 has been drawing down, as we said, and volatility has been subdued. No, Nifty 50, what is the... bear with. Okay, I don't see what is the rolling vol. So never mind, because I have better chart than this. I have better charts, so add Mayora to better things. Okay, let's start to see what are the VAR value at risk. Forget about football and the VAR, the ref, bonkers ref, you know what I mean? And these are value at risk. So so the DAX, value at risk at the DAX, it's 182%. So VAR 95, it's 182%. This is minus 2.39%. If the DAX, the VAR value at risk 97.5%, apologies. And VAR 99 is a minus 3%. VAR 99.9 it's a minus 5.1% all around the world. Okay, so this is very hefty, heavy tail, fat tails. And then the Japanese market, it's the 0.1 probability that the market can draw down in a day minus 6.6%, which is a very large drawdown. I think it's the largest together with the Chinese. Yes, equal parameter for the VAR 99.9%. So here we have the very nice value at risk parameters for each and every index that I considered here. And I put the German DAX because the DAX it's a bubble, the Nisba Nunca, the eternal recession mechanism bubble. And so I put it together with the Asian markets just to confront and see what are the parameters. And yeah, so here we have a nice table. What are the value at risk in the case of very large sell-off in the market? And with the relative charts, you see the clustering, the dots are the daily returns, and the dashed line are the value at risk days, thresholds, apologies. Yeah, the value at risk thresholds, and so the dots that are clustered basically at the threshold or below the threshold, those are violation of the value at risk parameters for these indices. And let's try and see here the Nifty 50. So there are these dots here, these are positive days, so plus 5%, plus 15%. So we have clustering on both sides. For 2024, we can see here that there are quite a few days of all sorts of value at risk violation all across 2024, as long as some excess return days above 5%. But we don't have. We see here, this is 2024. 2024 is nothing like 2020. This very large volatility, and also here, yeah, there is much less excess return and more consistent clustering here on the downside, if we want to see it as so. The Japanese market, we have in 2024 a lot of volatility, very large gaining days, almost 15%, and very large drawdown days. Yeah? Where we have clustering here also for the value at risk levels. The Jakarta Stock Exchange, the Indonesia Stock Exchange, yeah, we see that we have a few of these very large drawdowns for 2024. And this is the South Korea stock market. And there is a lot of clustering also on the downside, but also some excess return, near almost 10%. And yeah, Taiwan weighted index, also a lot of volatility. So we see that the Taiwan index also has some very large drawdown there, which are closer to the value at risk 99.9%. Let's see if the Taiwanese market moves. It's a drawdown of minus 4.6% or minus 3.9%. So we are between minus 4, minus 5%. So these are large moves, but we can appreciate a lot of value at risk days in 2024. So there are a lot of volatility in Asian markets. This is the NQ Global, Nasdaq Global, very contained also because we don't have a lot of data. FTSE China, a lot of volatility here. And the MSCI World Index, yeah, more or less, it's not so much volatility, but this, the Hang Seng, wow, this is a lot of volatility here. Between 2020 and 2024, a lot of dots are in the dashed line, the red, yellow, the green, the purple, so all sorts of value risk violations, all sorts of sell-offs. And yeah, so we can see here the rolling mean and the rolling standard deviation, 7, 21, 63, 100 days rolling standard deviation. And also I managed to gather the parameters. This is 0. Okay, this is 0.3%, the 21-day standard deviation. So it's a rolling mean. No, sorry, rolling mean is not standard deviation. So it's the rolling average return every 21 days. So it's very little. Okay, so we can appreciate here the charts that we see. Volatility in the DAX, moving average, they are very low. So not much volatility at the minute, but I think this we will have more volatile markets in the next month of March for sure. And the Nifty 50, yeah, also seems some subdued volatility, although we can see here that in the past months there has been some sort of higher volatility. I vol, let's see, rolling standard deviation, Nifty 50, yeah, 63 days rolling standard deviation, yeah, so this is 0.8%. Okay, so these are the past days in February. We are between 0.8, 0.85% on a daily basis, on a rolling daily basis. So the 100-day rolling daily basis, yeah, more or less the parameter is this one. Only the 7-day average, it's 0.3%, more or less, around these values for the Indian market, which is not negligible. But I can recognize here. So these are the let's see, rolling standard deviation. The Japanese market. This is a huge spike in the 7-day rolling standard deviation, and I think the 7-day it's because of here. These huge spikes has been for these July and August months. A lot of vol when we have the historical all-time high and the huge correction down, 31,000. So. Another thing that I want to say, and oh, it does no volume profile. No, you don't like the volume profile? Ah, wait. Okay, so back in my previous charts, so we can see here we have this the bar. It's a shadow, right? You have a shadow on the top, and then you have the body of the bar. Yeah. So what happens is that technically, when we go and see the volumes traded in the Nikkei 225, it means that this this fine line here. Let me use a brush. Yeah, this fine line here requires basically this bar to go down and to clear up all these transactions that have been basically left uncleared. That's why every time you see a shadow in the previous candle, that means that the market, there was a lot of volatility in the market, and there are transactions that or positions in the market that still have to be cleared. And so if you consider this big shadow here and this big shadow on the downside, I believe that then a lot of market volume will continue to the downside here to have a full body candle. I don't know if I've explained myself horribly, but I hope the message will come to you. So here we have the shadow. I don't find the brush. If I could find no, not the brush, how to cancel this stuff. But anyway, here we have the shadow, so this tiny line, and so here you have a full body candle. It means that all the transactions that have been, all the positions that are in the market, the Nikkei 225, just on the index, which are not being cleared, then the market will have to clear, the traders in the market will clear these transactions, and so we will have a full body candle, very much likely down to the downside, repricing down the market to 33, 32, 31,000. I think, but this work, it's done with the volume data. So just on the chart, it's very much a very rough approximation, but just to give you a flavor of that, Asian flavor. And so we see here very large spike in volatility, and yeah, I mean, all the rolling average, they've been all decreasing, so doesn't signal on a rolling average of the standard deviation, doesn't signal very high volatility. But let's try to see. We can see here, for example, the rolling mean. So the average 7-day mean return in the past days of February has been negative. You see minus, and these are 3 zeros after the 3 decimal zeros. So the average daily return has been negative, and also on a 21 days average, the average daily return for the Nikkei 225 has been negative, so the market has been selling off. On a longer time frame, 63 days or 100-day, let's say moving average, we see that the average daily return has been very, very little. Okay, and let's compare it with the volatility. Yeah, volatility is between 0.9 sorry, and 0.7% on a 21-day time frame. And yeah, so the 63 days, 100 days, we see that on average volatility has been of 1% daily. in the month of February compared on a rolling standard deviation average with 63 days before. Okay, so this is how you take the 63 day previous day standard deviation, and then you interpolate it with the most recent data, and then you have an average of the volatility measure. So the 100-day standard deviation moving average, let's call it this way, it's 1%. 1% on a 100-day moving average, which is interesting. So, for example, if we will have to see that the 21-day moving average of the standard deviation moving average will go to 1%, that means that will upgrade to a value which will cross. So this is the 200, this is the 100-day 1% standard deviation vol, okay, sigma, and this is the 21-day sigma. If this goes to, and it's 0.7, if it goes to 1%, then you have a cross. So it means that on a moving average dialogue, the volatility is going up. Okay, and this is only for the Japanese market. So the Jakarta Stock Exchange, so the Indonesian market already shows a higher vol, and we see that the mean return have been negative on a consistent basis. Whatever is the moving average, 7, 21, 63, 100 days, whatever you want, whatever you like, whatever you need, it's the average daily return has been negative. And the rolling vol, the 7-day rolling vol, it's like a rolling stone. It's plus 1% daily. This is 1.2%. So this is a very large vol. So we are on the range of a daily sigma of average daily sigma of more than 1%. So it's very high vol. Not very high, but it's a factor that shows you in the numbers what comes out from the chart. So this is the Taiwan, and rolling mean has been mixed, a little bit positive in the longer time frame. Vol, it's 2%. This is a higher vol. You see 1.8% vol, 21 days rolling average. Okay, so this is the weighted Taiwan index, and we have some higher vol from 0.100, like 1-2% range. So the rolling mean return more or less steady and not so exciting, but we see that the average sigma vol, it's 1.5%, 1%, 1.2%. These are all the past days in February. So on a 21 days average, 21 days, so technically 21 days is 3 weeks, but it's a whole trading month. So because a business week is 5 days, then 21 days it's enough to cover the 1 month of data. And the weighted Taiwan index, it's so on a monthly basis, it's between 1.3 1.5% average standard deviation. So it's interesting volatility here as well. This is the Kospi, and just leave it quiet, but we have negative average returns on a 100-day moving average, blah 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 blah. Okay, a lot of talking. So let's see what else I've got. I've got a lot of things as usual. I have my standards stuff. So let's have a rough idea. So the jump diffusion method, so we know that, okay, lambda jump. So this lambda parameters, it tells me that for 2.16 days, business day in a year, the DAX has a jump, so it can open lower or minus 4.8%. And then you can compare the jump in the index, open lower, or it has a drawdown, like a jump in the price of minus 4.8%, and the volatility of the sigma, it's 0.0162, and yeah, these are the mu, the average yearly return, which is 12%, the average the yearly volatility, which is almost 20% sigma. So, but this is interesting. So for there is the probability that for 2.1 days in a trading year, in a business year, then the DAX can have a jump in the price of minus 4.8%. So this is a measure also of unexpected volatility. So let's see. I would like to see Nikkei 225. It doesn't give me the parameters. Oh, this is very disappointing of you. So let's see the Indian. Oh, the Nikkei 225. Oh, I have the parameters here. Oh yeah. Okay, it's jumping and shifting all over. Okay, so the Nikkei is here. This is the simulation. But let's see the parameters. Okay, so 1 point, the lambda 1.3 days a year, but the mean jump, it's minus 6.05%. And if I go quickly, you should remember this minus 6%. It's a value very similar to this one. The Nikkei 225 has a very large VAR 99.9%. So 0.1%, it's minus 6.6%. So the jump diffusion method eventually does capture mostly the value at risk 99.9. So this lambda jump tells me that 1.35 days, so 1 day and a little bit more and a third in a year, the Nikkei futures, for example, can jump down, can open a gap low of minus 6%, and this basically compares and equates to the VAR 99.9, so to the 0.1% P of theta, right? Okay, so just to put together the two things, the jump diffusion method, it seems to me that captures the parameter which is more which approximates the most the value at risk 99.9. So time 150. So lambda jump, it's 1.2 days. It's 1.2, and the jump, it's, yeah, these are all VAR 99.9. I'm pretty sure. I'm pretty sure. Minus 4.78%. Okay, yes. So the jump diffusion method basically gives me another distribution of another statistical reference of what could be the value at risk 99.9%. Okay, so let's move forward. I would like to go through each and every data, but it's very cumbersome. So it's very Sherlock Holmes, did you find your clues? Any clues? Any joy? Bear with. Okay, bear with. Okay. So I will go with you. We will go together and have a happy Sunday park lunch with our great friends, and we will see what are the conditional volatility models and parameters for let's see the German DAX, how can be volatile, the conditional volatility, and let's see how, for example, the Nikkei 225 or the Nifty 50. Let's go through some parameters. Okay, so GARCH model, basic model, 1-1 model, mu, so the average daily return, the P parameter, it's the statistic, it's good. So the this is 0. Oh, it's a large coefficient, 9%. It's very large. Okay, so the baseline vol also is large, 0.05, and yeah, we have the alpha and beta parameters, which also are significant. Nevertheless, okay, so these T statistics, these P values, they are all statistically significant, but these omega and mu parameters, to me, they are too large. So let's go forward. Oh, this coefficient, okay, yeah, okay. GARCH, which can explain more of the asymmetry in the conditional vol. Okay, the mu parameter, okay, 10% of mean return, okay. Let's take it for good. So the baseline vol, 2% omega parameter, the baseline conditional volatility for the whole time series. So these data are from 2010 up to February 2025. So the alpha parameters tells me, okay, the past shock square residual explain today volatility for today conditional vol for 29.39%. The beta, the persistency of this conditional volatility shock, is 94%. Yeah, let's make it 94%. Let's make the DAX happy and joyful and merry and cherry and have your cake and eat it. So no, it's not too much diabetes. Anyway, so let's go to other models and see what is the gamma parameters. This is interesting, yeah. Okay, so this GARCH model and GARCH model. So these models that estimate the covariance and the conditional volatility of the historical time series. You can see here the GARCH model starts to model the parameters for the asymmetry of the shock. What the GARCH and GARCH model do, they introduce the value, the parameter, which is the gamma parameter. So the gamma parameters tells you how large is the asymmetry shock, if it's positive or it's a negative shock, which are more prevalent. Okay, so let's compare the alpha parameter. This is the these are the GARCH model. Okay, so we can see here the mu parameter, it's a bit lower, so the average mean return it's 0.069 more or less. The t-stat, it's the p-value, they are all statistically significant, and we have the range within we have the 95 confidence interval for the range of the coefficients, and so mu parameter is a bit lower, the baseline volatility, the omega parameter is a bit lower, then the alpha parameter says, okay, past shock of square residual conditional vol do explain 6.1% of the present day conditional vol, the persistency of conditional volatility shocks on the of prices of the DAX 40, so the persistency of volatility is 85%, and the asymmetry of the gamma parameter is 13.8%. So in this case, I would assume that because the gamma parameter is positive, the asymmetry, it tells me that there are positive shocks for conditional vol, so it means that there is higher volatility, and it means that the price of the DAX goes down. So higher vol, then you have a sell-off in the market. And so the gamma parameters just quantifies the asymmetry in the shock. Let's go and compare it. Go compare with the so this was the GARCH parameter, sorry. So the GARCH data are up here. This is a bit of a confusing overlapping of data. Okay, so omega parameter 4%, let's 4.004. Okay, the omega parameter is very similar. The mu coefficient, mu, it's higher. Oh, it's higher here. It's 0.07, and this is the GARCH. So the GARCH distribution has a higher mu parameter with respect to GARCH model, and so the gamma parameter it's higher. So it tells me that the asymmetry of the volatility shock it's 15.7%. The alpha parameter, so how the past shocks are explained today volatility for 5.36%, and the persistency of vol it's 83.5%. The p-values, they are all smaller, very small, close to zero, so they are all statistically significant, and so the gamma parameter is 0.15, and the range is between 0.115 and 0.20. So these are the ranges within the 95 confidence interval. Where I could, for example, ask the machine and say, okay, set the parameter for 99 confidence interval, okay? And so the machine will work through the parameters in that way. And here we have the charts. Okay, so this is the GARCH conditional vol, historical term conditional vol starting 2024, and we have this tiny bit of line up, a little bit. What's the line up? And yeah, so maybe there will be a bit of more vol, but anyway. So Nifty 50, my 50, my. Alright, so let's go and see just our new friends, GARCH and GARCH. Okay, Nifty 50 GARCH model, mu coefficient, the p-value is okay, so 10% average return. So the baseline vol is 6%. So past shocks explain for 8.35%. Conditional volatility in markets. The asymmetry of shock it's 10.3%, and the persistency is 82%. We see that the p-values, they are all significant. These are the range. This is a very wide range. So the beta parameter is 67 to 97. So it's a very wide range. Anyway, let's compare with the GARCH model. GARCH. Tosto a D. Allora, so let's see. Omega alpha parameter, the gamma parameter, it's 11.8%. So the asymmetry of the shock, it accounts for a 12% more or less. Okay, so the range is very, very wide. This is at 2 decimals after the 0. Okay, so the p-values here, no, they are not so good. They're not convincing to me. But anyway, the charts, they don't tell me there is a lot of higher vol, unless we go and see that there are clear peaks of this one, which is huge, but it's 2020, so we know exactly what it was. And let's see the Japanese market. Okay, GARCH model, NIC 225, and GARCH model. Okay, these are all 1, so it's a draw. Okay, so mu parameter 0.09, p-value, so all the p-values, they are all good. So the volatility, the asymmetry in the volatility shock, it's 12% and change. The baseline vol, let's say on a yearly basis, is 7.9%, and the past square residual shocks in conditional volatility explain the daily conditional vol for 7.6%. The baseline, the persistency of volatility, it's 82%. So these are the parameters for the Nikkei 225, and you can use these parameters to play around with the option chain for the Japanese market if you fancy to do so. And so GARCH model, omega alpha parameters. No, I think there is so much overlapping on this stuff that it makes difficult to read properly the data. So let me model it here. I don't see where this stuff has gone. I don't want to waste so much time doing that. Anyway, so what else? Well, let's see the yeah, okay, these are the Gaussian distributions. So with this one you can see the distribution of daily returns. So this is the DAX. This is a standard normal distribution. The red line fits the curve, and you can see that the extreme values, when it's 3 standard plus or minus 3 standard deviation, we are talking about a plus or minus 5% daily return. Although here very, very small, there are the very small bars with the plus or minus 10%, but those are very rare occasions. Okay, more or less all the distribution they have a plus or minus 5%, which is the most visible values. But you have the Hang Seng. We can see how there are more larger tails for the 3 standard deviation, even 7.5%. So okay, these are also very useful charts because we can see the 21 days moving average in volatility compared with the 63 days moving average. So we can see here the Jakarta Stock Exchange, there is higher volatility, there has been higher volatility in the past months, and also the mean return has seen higher vol. The Nifty 50 is more or less not moving much, and here this is the Taiwan Stock Exchange. I think that the red line will follow through in a higher vol. Also the Taiwan weighted, probably there will be higher vol. and FTSE, the Chinese market, probably higher volatility. Please don't do any bullshit there in Asia, Taiwan and stuff like that. I'm talking about the stock market, so please don't be www.confused.com is too late.co.uk. Hang Seng also will go higher in vol, probably, and yeah, okay, these are the value at risk dots with volatility. Okay, so these are the tables. So I love you and leave you with the total of the value at risk days. Okay, so for example, how to read these things. The DAX 40 in the past 15 years of data, it has accumulated 188, you can read the number better than me, value at risk days, value at risk 95. Okay, so let's do a quick, okay, so 252 days in multiplied 10 years of data, 2520. Okay, so let's do 188 divided 2520, and so we can see that 7.46% of the trading days in the past 10 years of data have been VAR 95 days, and so forth and so on. You can take a screenshot of this chart. This table is very useful. You can take a screenshot, keep it with you, and so you can see here that, for example, the NQ Global, the Nasdaq Global, it has the highest number of VAR 99.9. So very low probability of large drawdown in one day. And for the value at risk 97.5, we see that the DAX, the Jakarta Stock Exchange, and the iShare MSCI World Index ETF, they have the most days, 100 and more days of value at risk violation for the 97.5% parameter. And the lowest one is the China FTSE 50 China. And yeah, also the VAR 99.9, this not so much volatility. Yeah? The FTSE 50 China, it doesn't show me so many days. It has the lowest number of days for all four different value at risk thresholds. So this is interesting from a passive investing standpoint. You want to go long FTSE 50 China, go long, no problem. There are not so many value at risk days. I would not be so sure about the NQ Global. Let's see NQ Global. Go, Share. No, it doesn't find it. I'm sorry, I can't. Yeah, here we have it. Ecco study, eccolo qua. Yeah, so we see the NQ Global. This is very interesting. We are talking about the bubble, the double, triple bubble. Yes. So we can see here that probably the RSI, for example, it could be drifting down as a signal, market signal, technical signal of relative weakness in the market. But nevertheless, I won't exclude that the Nasdaq Global will start to see a sell-off, considering that also Asian market and the main American stock market will start to have a massive repricing of stocks. But nevertheless, we can theoretically theorize our theory of the hot air bubble, that maybe we can start to go here minus 27-28% and go and see how are the Senku cloud span, something like that. But anyway, these are the value risk parameters, and I've been very, very happy to be with you today. It has been very exciting, and don't forget our weather forecast. We are forecasting a monsoon season and storms coming to the stock markets. I will love you and leave you. I wish you a very good day, and thumbs up. See you to the next episode.